Passive investing sounds like a dream. You can leave the hassle of actually managing your investments to the professionals, right? Well, yes. And no. Passive investing can be an effective way to invest your money if you understand the pros and cons first. Passive investing is a strategy that involves holding stocks in a portfolio without actively managing them. It's a good way to grow your money passively over time. But it doesn't work for everybody, especially not as opposed to active investing. It makes sense. If you're not willing or able to spend time researching companies, reading financial reports and keeping track of stock prices on a day-to-day basis, then why would you want to do so with your passive investments? Keep watching to learn more about passive versus active investing so you can make an informed decision. What is passive investing? Passive investing refers to the practice of investing your money without actively managing it. In other words, you're simply letting the market do the work for you. The most common way to do passive investing is with a mutual fund, which pools money from investors and invests it in a range of stocks and bonds. Some mutual fund companies offer funds that are designed to grow your money passively. You select a small amount each month, invest it in a range of stocks, and forget about it. When you select a mutual fund, you're trusting the investment manager to diversify your portfolio and pick appropriate investments. Active investing. Active investing refers to the practice of using professional money managers to select investments for your portfolio. It can also include the use of index funds, which track the performance of an entire market, like the S&P 500, without actively trying to outperform it. Why would anyone choose to do this? There are a few reasons. For one thing, active investing lets you diversify your portfolio. That is, you can spread your risk across a wider range of assets by investing in a mix of different stocks, bonds and commodities. Active versus passive investments. Why would you want to diversify your investments? If you're young and just starting out with money saved for a future goal, your money might be safer if you put it in a range of different assets. But let's say you have $1 million to invest. If you only put it in stocks that happen to work out perfectly, you would only lose $1 million without gaining anything. Therefore, a lot of risk is involved in that scenario. Passive investing is a great way to grow your money over time, but it doesn't work for everybody, especially not as opposed to active investing. If you want to try your hand at active investing, you can set up a brokerage account and hire a financial advisor. The benefits of active investing. Diversification. If you have $1 million to invest and you put $500,000 in stocks, you've only got $500,000 in risk. But what if one of those $500,000 investments blows up? You've still got the rest of your $1 million to use. Potential for high returns. You're likely to earn a high return on your investment with active investing because you're investing your own money, not a government grant. You're likely to earn a high return on your investment with active investing because you're investing your own money, not a government grant. Access to financial professionals. Investing your own money means hiring a financial professional to manage it. You might want to hire a financial professional because they have more experience than you, access to more information than you, or a different set of financial goals than you. The disadvantages of passive investing. Lack of excitement. Some people love the adrenaline rush of investing money. They find it exciting, even thrilling, to see the results of their decisions and have a sense of accomplishment from it. Some people love the adrenaline rush of investing money. They find it exciting, even thrilling, to see the results of their decisions and have a sense of accomplishment from it. Investment decisions are highly personal. When it comes to your money, you have to make highly personal decisions. You have to decide which investments to make, what risk level is acceptable to you and which returns you're happy with. When it comes to your money, you have to make highly personal decisions. You have to decide which investments to make, what risk level is acceptable to you and which returns you're happy with. Lack of control. You've probably heard enough stories about people who had to get their money out of a bad investment before it really got screwed up. You've probably heard enough stories about people who had to get their money out of a bad investment before it really got screwed up. How to choose between active and passive investing. If you're not sure which type of investing to choose, you might want to look at the following considerations. Do your research. Passive investing has its benefits, but it doesn't work for everybody. Pick one and stick with it. Active investing also has its benefits, but it also has some drawbacks. Pick one and stick with it. Conclusion. If you're not willing or able to spend time researching and managing your investments, then you might want to consider passive investing. There are a lot of benefits to doing so, but there are also a few disadvantages. Before committing to a particular type of investing, it's worth doing some research to make sure it's right for you and your situation. Passive versus active investing is a complex topic, but it can help you make an informed decision about what type of investing is best for you.